Welcome to DM News English, and you're watching the program Pulse Room with Shakil Ahmed from Birmingham studio. Gold prices are surging these days, but is it a safe haven rush or a warning sign? Let's break it down, and we have been joined by Dr. Hafiz Usman Rana. Hafiz, thank you very much for joining us. My first question, gold has surged to historic heights, crossing around 5,000 US dollars an ounce after a dramatic rally this year. Investors are piling in, central banks are buying aggressively, and markets are asking, is this a smart hedging or a sign of deeper trouble in the global economy? So what would you say about this, please?
If we are being precise, so it's both warning signal, also the safe haven, but interpretation is more interesting right now. It's like gold always benefits from uncertainty. So yes, it's a classic safe haven, but what stands out since 2023 is that gold didn't behave the way the textbook would predict during a high rate environment. So when you see real yields rise, gold usually faces pressure because it doesn't generate income. So yet gold remained resilient and then strengthened further into 2025 and 2026. But if you see the history, gold's modern monetary rule becomes clearer after the breakdown of Bretton Woods in the early 1970s. So once gold was allowed to float, it became a kind of market-based referendum on monetary credibility. Okay. So if you see over the long run, gold has tended to outpace inflation, not in the straight line, but as a function of periodic monetary and geopolitical stress. So what we are seeing now looks like the kind of regime concern about fiscal sustainability. Also, you can see the large debt burdens and geopolitical fragmentation that I have also written in my recent piece. So I would say, yes, safe haven, gold is a safe haven, but also a signal that markets are pricing long-term uncertainty about the global monetary order.
Hafiz, now importantly, what are the drivers, what are the factors that are driving this surge in gold prices, please?
I would say I would group into three different key drivers. One is official sector demand. Second one is institutional financial demand. And the third one, which is very important nowadays, is like political economic risk. So if you see the central banks since around 2010, central banks moved from net sellers to net buyers. But what changed decisively since 2022, 2023 is the scale. So central banks have been buying around 1,000 tons a year, but put that, beside global mine supply at roughly 3,200 tons annually. And you realize that the official sector is absorbing close to 1/3 of new supply. And they typically don't sell much. Another factor is the institutional flows. If you talk about the ETFs, gold ETFs, that side matters because it reflects broad investors' allocation decisions. So if you talk about the World Gold Council data for early 2026, that clearly indicates that global gold ETF holdings above 4,100 tons. And that assets under management around, you can say 669 billion US dollars. So that tells you that gold is not only being, you can say, brought as a jewelry or coins, it's being held as a portfolio asset by institutions at scale. And the third factor, which I mentioned, the political economy risk, sanction risk, reserve diversification, and the desire to reduce reliance on a single currency. So gold is a neutral asset. Gold has no counterparty risk, no default risk. And it sits outside the, you can say, digital plumbing of any one country. So in a world that feels more fragmented, that feature has become more valuable. So the surge nowadays is not one story. It's the combination of structural official demand, and you can say that broader portfolio reallocation.
Exactly, like you mentioned, but importantly, asking as the different governments, if we talk about inflation is easing in several major economies. If inflation is cooling down, why is gold still climbing, please?
This is a key point, you mentioned now.
Yeah.
The market is actually not only trading inflation, you can say that it's trading credibility and long-term risk. So
Okay.
if you see for a long stretch, especially between 2007 and 2023, there was a very tight relationship between gold and real US rates. So you could almost invert real rates and get the gold line. But if you see in 2023, the relationship broke and gold didn't fall as rates rose. So that tells us that something structural entered the market. So one reason is that inflation easing doesn't automatically remove the long-term concerns. And also, if you see, investors look beyond the current CPI print. So they look at debt dynamics, fiscal capacity, and whether the monetary policy remains credible under political pressure. So gold tends to respond that broader set or risk. And also you can see that inflows, the ETF data in early 2026 that shows strong demand even as the inflation has cooled in parts of the developed world. So what that means gold is being used as a strategic allocation and not merely as an inflation panic trade. So the simple answer, I would say that inflation can cool, but if uncertainty about the long-term monetary and fiscal path remains, gold can still rise.
Thank you very much, Hafiz. It was great discussion about gold. I'll catch you next time. Thank you very much.